Everything you have been told about the current price of gold is a distraction. The numbers flashing on your screen right now are not a reflection of value. They are a deception masking the greatest asset mispricing of the last century. We are currently staring at a mathematical paradox that defies every rule of free market economics. Imagine a scenario where the product a company sells skyrockets in value by 300%, yet the company's stock price collapses to historical lows. That is not a market fluctuation. That is a coiled spring. We are standing on the precipice of a liquidity event so severe it has been compared to trying to force the entire volume of a massive hydroelectric dam through a garden hose. When the pressure valve finally snaps, we won't just see a bull market. We will witness a vertical displacement of wealth. Let's fast forward to the very near future to understand the gravity of the situation. Picture the landscape of January 2026. In this projection, the spot price of gold has quietly surged toward $5,000 an ounce, driven by sovereign accumulation and currency debasement. However, the mining companies, the very entities that own this wealth in the ground, are still priced as if gold were trading at $2,000. This is the anomaly. The all-in sustaining cost to pull an ounce of gold from the earth have remained relatively stable, hovering around $1,500. Do the math. At $5,000 per ounce, the net margin is $3,300. That is a profit margin that would make a software company jealous. Yet these mining stocks are trading at valuations that suggest bankruptcy. This disconnect is the opportunity. This situation creates what market veterans call a liquidity trap. The entire market capitalization of the gold and silver mining sector is laughably small. You could take the combined value of every silver miner, every gold producer, and every junior explorer on the planet, and it would still be less than the market cap of one single Silicon Valley tech giant. Now, consider the ocean of capital currently parked in overvalued technology stocks and failing government bonds. Trillions of dollars are sitting in pension funds and sovereign wealth accounts, desperate for a safe harbor as inflation eats away at returns. When the realization hits that paper assets are a burning building, that capital will try to rotate into the only sector with tangible value, the miners. But here's the problem. The mining sector is too small to absorb the money. It is the garden hose. When trillions of dollars try to enter a sector worth only a few $100 billion, the price of admission doesn't just go up, it goes parabolic. We're talking about a physical displacement where stock prices are forced to re-rate not by 10%, but by multiples of 10. In previous cycles, specifically the 1970s and the early 2000s, we saw junk stocks deliver 10-to-1 returns simply because a wave of money lifted every boat. Today, the setup is exponentially more explosive because the disparity between the paper price and the physical reality has never been wider. The most dangerous fracture point in this entire system is silver. While gold is the money of kings, silver is the restless, volatile cousin that creates empires. The structural bottleneck in the silver market is something that 99% of investors completely misunderstand. They assume that if the price of silver rises, miners will simply dig up more silver. This is false. The vast majority of the world's silver, nearly 80%, comes as a byproduct of mining for other base metals like copper, lead, and zinc. This means you cannot simply flip a switch to increase supply. To get more silver, you have to build a massive new copper mine, a process that takes 10 years of permitting and construction. We are facing a 6th consecutive year of structural silver deficits. The vaults are being drained and the ground is not giving up enough metal to replenish them. Even if silver were to hit $200 an ounce tomorrow, the global supply would not increase meaningfully for a decade. This is the definition of a supply-demand trap. When institutional fear of missing out hits the few pure silver miners that actually exist, companies with tiny market caps under $500 million, there is nowhere for the price to go but vertical. The leverage here is not in the senior producers who are already fat and happy. It is in the junior sector, the explorers and developers who are sitting on the future supply that the world is desperate for. To understand why this timing is critical, we have to look at the industrial forces that are about to hijack the silver market. We are moving from a digital economy built on credit to a resource economy built on atoms. In this new era, silver is the new oil. The primary driver is no longer just jewelry or silverware. It is the survival of the modern technological state. Artificial intelligence is not just code, it is hardware. It is vast data centers and high-performance chips that require the most conductive metal on the periodic table to function without overheating. That metal is silver. As the demand for AI processing power doubles every few months, the industrial requirement for silver in semiconductors and heat management systems is scaling at a rate the mining industry cannot match. We are looking at a market where investment demand is competing directly with the industrial survival of the world's most powerful tech companies. When a tech giant realizes they cannot produce their next generation of hardware because of a silver shortage, price becomes irrelevant. They will pay whatever is necessary to secure the physical metal, bypassing the paper markets entirely. This industrial panic buying is the spark that will ignite the revaluation. Then there is the green energy transition. Photovoltaic solar cells are currently the largest single consumer of silver. Despite attempts to use less metal per cell, the sheer volume of global solar installations has negated any efficiency savings. In fact, the new high-efficiency solar panels require even more silver than the older models. By 2027, the solar industry alone is projected to consume 20% of the total global silver supply. Add to this the electrification of transport, where every electric vehicle requires nearly double the silver of a gas car, and you have a recipe for a total inventory depletion. We must also consider the geopolitical dimension, specifically the behavior of the East. For the past decade, central banks led by China and Russia have been aggressively accumulating physical gold. They are not buying paper contracts on the New York Exchange. They are taking delivery of physical bars and moving them into sovereign vaults. This is a strategic move to dollarize their economies. The persistent premiums we see on the Shanghai Gold Exchange prove that the East is already pricing gold higher than the West. They understand that the Western paper price is a manipulated ghost, a remnant of a system that no longer reflects the scarcity of the Earth's resources. This arbitrage creates a drain on Western vaults. Metal is leaving London and New York and moving to Shanghai and Dubai. Once it leaves, it does not come back. We are entering the takeoff stage, where the public begins to realize that they cannot build defense systems, electric batteries, or AI chips with digital digits on a screen. You need the physical element. The Hoover Dam of capital is pressing against the cracking concrete of the paper market. When the dam breaks, the flow of money will not be orderly. It will be chaotic, violent, and incredibly profitable for those who are positioned in the right assets before the breach occurs. The psychology of the public plays a crucial role here. In every major historical cycle, there comes a tipping point where the general population loses faith in their currency. We are seeing the first tremors of this in the West today. When the average person realizes that their savings are being liquidated through inflation to pay off national debts, they don't just buy a little gold, they panic into it. But the retail investor is late to the party. The smart money moves when the sector is hated, when the valuations are absurdly low, and when the fundamentals make no sense to the mainstream media. Currently, institutional ownership of mining stocks is at near record lows. Most pension funds have zero exposure. They are still chasing the growth stories of the last decade. But history tells us that when the growth story dies, capital rotates to value. If these multi-trillion-dollar funds decide to move even 1% of their assets into gold and silver miners, the sector effectively doubles overnight. The garden hose bursts. We are positioned at the base of this historical reconciliation, watching the pressure gauge climb into the red. So, how does this play out? We are monitoring three distinct paths for the final innings of this cycle. The first is a great revaluation, where central banks are forced to officially reprice gold to backstop their currencies, sending mining stocks into the stratosphere. The second is an industrial hijack, where tech and defense companies start buying mining stocks directly to secure their supply chains, triggering massive buyout premiums. The third, and perhaps most devastating, is a paper market default, where the exchanges announce they can no longer fulfill physical delivery, revealing the paper contracts as worthless claims on an empty vault. Navigating this requires surgical precision. This is not about throwing darts at a board. It is about understanding the difference between a producer in a safe jurisdiction like Nevada and a developer in a high-risk zone. The greatest gains will be found in the Tier 2 developers and Tier 3 explorers, the companies with market caps under $500 million that are sitting on high-grade deposits. These are the stocks that can deliver 100-to-1 returns when the mania phase begins. But they are also the most volatile. The key is to position yourself now while the sector is quiet, while the mainstream financial news is ignoring the data. The Hoover Dam is full. The water is rising. The concrete is cracking. The transfer of wealth from those who hold paper to those who hold resources is not a possibility. It is an inevitability driven by geology and math. The only question remaining is not if it will happen, but if you will be standing on the high ground when the flood begins.